Today we're talking about the 28-year-old who scammed JP Morgan. Over the years, fintech companies have become a threat to conventional banks. These fintech are businesses using technology to provide financial services like mobile payments and online banking, which is making it harder for traditional banks like JP Morgan. Younger generations prefer managing their finances from smartphones rather than going to a bank branch. To cater to this demographic, JP Morgan CEO Jamie Dimon went on an acquisition spree, buying up small fintech startups worldwide. One of these startups was Frank, a college financial planning platform founded by a visionary 28-year-old Charlie Javice. In 2021, JP Morgan Chase acquired Frank, founded by Charlie Javice, for a whopping $175 million. However, they soon discovered that the company's customer data was completely fake. According to the lawsuit, Javice paid $18,000 to a data scientist to create 4 million fake customer accounts to make the company appear more credible. The bank's lawsuit alleges that Frank's reported user numbers were grossly inflated, with the company claiming to have 4.25 million users at the start of 2021, when in reality it only had around 250,000. According to the lawsuit, Javice and her team fabricated the vast majority of the user names and email addresses associated with these accounts, leading JP Morgan to pay a premium price for a company that was far from as successful as it had been made out to be. Charlie has been fooling the world for years, even before founding Frank or allegedly defrauding JP Morgan. But how did she do it? Well, that's what we're going to find out today. Investors and the media portray Charlie Javice as a groundbreaking young entrepreneur. Her financial aid startup Frank was featured in top national dailies like the New York Times, CNBC, and the Wall Street Journal. Although Charlie Javice positioned herself as an innovator with groundbreaking solutions to student loans and solving global poverty, her greatest talent may have been leveraging top institutions and national news outlets to gain an ever-growing platform. As Javice accumulated accolades and media appearances, no one seemed to question the fundamental claims of her businesses until the day JP Morgan alleged the numbers didn't add up. Although Javice's path to success was fraught with exaggeration and deception, her downfall began when JP Morgan dug into the numbers. Barely a year after selling Frank to JP Morgan Chase & Co., the bank accused the 28-year-old of fabricating millions of client names and emails, the overwhelming majority of her company's users. The bank asked for customer data during their due diligence process, but instead of providing actual data, Javice decided to invent several million Frank customer accounts out of thin air. In 2020, bipartisan members of Congress called on the Federal Trade Commission to investigate Frank's deceptive practices and issued a temporary restraining order. However, JP Morgan still decided to go ahead with the acquisition. Now, JP Morgan is suing Javice for lying about her startup and defrauding them for such a large sum of money. What's even more crazy is that the outcome of this case could potentially have a catastrophic effect on any future deals between startups and larger companies. So what will happen to Javice and the fintech industry? Will JP Morgan win the lawsuit, or will Javice come out victorious? The fallout from the lawsuit has been swift and severe for Javice, who has been dropped from the Forbes 30 Under 30 list and had her reputation severely damaged in the media. But the real question is, how could Javice deceive so many people for so long? One possible answer is that she was simply a talented storyteller. Javice was able to spin compelling narratives around her business ideas, using her youth and status as a female entrepreneur to gain attention and funding from investors and media outlets alike. But that's only one part of the story. Javice also leveraged the power of top institutions like Wharton Business School and national news outlets like Forbes and the Wall Street Journal to gain even more exposure and credibility. Despite numerous warning signs and red flags, investors and media outlets continued to buy into Javice's narrative, fueling her rise to success even as she continued exaggerating and deceiving. As for what happens next, it remains to be seen whether Javice can salvage her career and reputation in the wake of the scandal. But one thing is sure, her story is a powerful reminder that success is not always what it seems, and that reputation can be a double-edged sword.